As 2023 comes to a close, investors and analysts alike get excited about what's next for the market. This year has been good for the market, and many are saying that 2024 will be the year of dividend stocks. This is why today we'll discuss 5 dividend stocks that I'm sure you have never heard about, with some of them offering crazy dividends. We picked different shares with very interesting investment angles, like one that sells one-day expiry options and pay out the profits as dividends. Anyway, there's a lot to unpack, including the catalysts accompanying each of these stocks, which could lead to future growth in both price and dividends. So stay tuned. Welcome back to PST Finance. First, I'll talk about a solid source of dividends preferred by many investors who want to diversify their portfolios, and that is a REIT. For those unfamiliar with the term, a REIT is a real estate corporation that owns and manages real estate properties, earning at least 75% of its revenues from real estate-related activities. To qualify as a REIT, companies must follow a certain set of rules. In return, they aren't taxed at the corporate level. An example of those rules would be that REITs must distribute at least 90% of their taxable income back to shareholders as dividends, which is why REITs usually offer higher yields. Over the past 12 to 18 months, the REITs market has been under intense pressure due to the Federal Reserve's increasing interest rates, which led to a decline in real estate prices and an increase in REITs' borrowing costs. But when looking at the future, it's likely that the Federal Reserve will stop these interest rate hikes, which could be good news for REITs. One REIT that can benefit from the drop in interest rates is ARMOR Residential REIT, or ARR. A good opportunity ARR presents is that it faces very little credit risk, since its portfolio comprises nearly 99% agency-backed securities. However, it does face other risks. For starters, ARR leverages up to boost its earning power, which isn't strange to a mortgage REIT, but ARR is more leveraged than its industry peers. For example, ARR's total debt-to-equity ratio is around 930.72%, in contrast with similar leveraged companies in the industry like AGNC's 701.57% and NOI's 712.48%. Less leverage is important for mortgage REITs since it gives them the opportunity to take on more debt later and purchase better yielding or more attractive securities down the road. With a higher leverage, ARR is at a disadvantage, which could lead to less flexibility. Another risk is that ARR gets about half of its repurchase agreements, which are how it raises short-term funding through Buckler Securities, in which it owns nearly an 11% stake. Relying on just one party for much of its funding creates some counterparty risk. Additionally, it faces the industry risks associated with mortgage risks, such as prepayment risk, which is the risk involved with the premature return on a fixed income security. When this occurs, investors must invest again at current market interest rates, which are usually much lower. So investing in this REIT is risky, but it could yield a good profit when interest rate cuts happen. As of December 2023, ARR offers an annual dividend yield of 25.13%, which is extremely attractive to investors. The stock price is currently around $19, and it recently gained roughly 2%, so it offers a good opportunity for investors interested in taking a long position for the stock or holding it if they already had it. Another dividend option, which is fairly new but still very interesting, is Defiance ETF QQQY, the first put-right ETF using daily options bought and expiring on the same day. While extremely risky, daily or zero-day options have very little time value because they will expire on the same day, so traders buy these options and pay very little money for the time value, hoping for a final move that will earn them massive gains. QQQY aims to achieve consistent and exceptionally large monthly yield distributions for investors, accompanied by equity market exposure to the NASDAQ 100. It's constructed of treasuries and NASDAQ 100 index options. Basically, its strategy is selling options at a premium on a daily basis, which leads to large monthly dividends. This ETF primary investment objective is to seek current income, while its secondary objective is to gain exposure to the performance of the NASDAQ 100 index subject to a limit on potential investment gains. In simpler terms, the fund becomes most profitable when it successfully bets against zero-day options investors shooting for the moon and, in turn, sells short-term and overpriced options to collect premiums. This makes the fund a safe option for investors who want earnings from NASDAQ 100 stocks but without the risk, and this comes at the high price of QQQY's expense costs, which are 0.99%. On the other hand, the average ETF expense cost in 2021 was 0.16%. As of 30 November 2023, the ETF offers a yield of 3.41% on its monthly dividends with a distribution rate of 60.52%. One share trades at around $17.05. The company behind QQQY, Defiance ETF, has proved its success and contributed to the rise in thematic ETF in 2020. Even though it was founded in 2018, it produced a $1 billion fund in FIBG in 2021. So QQQY could be sustainable and really successful, and it recently announced a $0.93 distribution per share at a distribution rate of 60.52%. The next stock I'll talk about is AES stock, which could be poised for future growth as global demand for renewable energy increases. AES Corporation is a utility and power generation company, and like the REITs market, the energy sector was negatively affected by the Federal Reserve's increased interest rates. This is because most companies that generate clean energy need heavy amounts of debt to finance infrastructure expansion, such as solar and wind farms. Higher rates increased borrowing costs sharply, leading to AES stock falling by nearly 51%. So companies like the AES Corporation could benefit from the expected cut in federal rates next year and the growing demand for clean energy in the US and globally. In 2022, the global renewable energy market reached $970 billion, and it's expected to reach over $2 trillion in 2030. On the other hand, the American renewable energy market is valued at $269 billion, with renewable energy being the fastest growing energy source in the country. AES is well positioned to benefit from this growth, as it is the #1 seller globally of clean energy to corporations through power purchase agreements in 2021 and 2022, and it revealed plans to grow its portfolio of renewables by 25,000 to 30,000 megawatts by the end of 2027. According to the AES Corporation's Q3 results for this year, there is a strong increasing demand for long-term contracts for renewables, evidenced by the new power purchase agreements worth 3.7 gigawatts the company signed this year. The company expects that number to reach 5 gigawatts by the end of the year. This is part of the company's plans to enhance its renewables portfolio and sell stakes in coal-fired power plants to achieve its goal of exiting the majority of its coal assets by 2025. Other industry peers like Consolidated Edison Incorporated, Entergy Corp., and Missource Inc. also plan to exit coal by 2030 and expand their renewables portfolio. The U.S. government, which passed the Inflation Reduction Act in 2022, encourages this shift. This new regulation includes increases, extensions, or new tax credits for onshore and offshore wind, solar, storage, and hydrogen projects, which could increase demand for AES's renewable products. As the company grows its renewables portfolio and as demand for renewables grows, it could see significant growth in the future. The company also expects a 10% average annual growth of its rate base in the upcoming years, which is one of the highest rates in the entire utility sector. The company has exhibited consistent earnings growth over the last 5 years, with a 9% growth in adjusted EPS from $1.08 to $1.67 and a 6% growth in dividends from $0.48 to $0.632. Currently, its stock trades at around $18, offering an annual dividend yield of 3.64% and could offer high benefits for investors once interest rates normalize. The fourth dividend stock I'll talk about has been increasing its dividends for 51 consecutive years, and it's the pharmaceutical company AbbVie's ABBV stock. Aside from its attractive dividend yield of 3.97%, AbbVie caught the attention of the market when it announced that it would acquire ImmunoGen, a biotechnology company, and Cerevel Therapeutics, a biopharmaceutical company, for $10.1 billion and $8.7 billion, respectively. These deals could provide significant benefits for AbbVie in the future. For instance, ImmunoGen's product, Elahere, is the first antibody-drug conjugate approved for treating platinum-resistant ovarian cancer. Its sales reached over $212 million in the first 9 months of 2023 and are expected to grow steadily. In a press release, AbbVie said that the acquisition will accelerate its entry into the market for treating solid tumors. Additionally, the company thinks that Elahere sales could take off in 2030 and afterward, reach billions of dollars if approved for larger segments of the ovarian cancer market. As for Cerevel, the company doesn't have an approved product yet, but its lead candidate, tavapadon, is currently being evaluated in a Phase 3 study targeting Parkinson's disease. Results from this study should be announced in 2024. In fact, AbbVie announced that it acquired Cerevel to expand its neuroscience portfolio and make use of its late-stage asset emraclidine, which has the potential to transform the standard of care in schizophrenia and other psychiatric conditions like Alzheimer's disease. These acquisitions align with AbbVie's long-term growth strategy and enable the company to diversify further the areas in which it operates. The reason behind the acquisitions could be the company's desire to grow after its stock dropped by 11% this year after its top-selling drug Humira lost patent protection and witnessed reduced sales amid increased competition. ABBV stock currently trades at around $150, and the company announced a dividend increase to $1.55 in October, which made its dividend yield above the industry average of 2.4%. Since the two acquisitions aren't expected to bring in profits for AbbVie until 2030, this stock could be a good investment for patient investors who are looking for a blend of stable dividend income and growth potential. The final stock I'll talk about is Cisco Systems CSEO stock. Cisco Systems is a multinational technology conglomerate specializing in networking and communications technology, providing various products related to this sector. Currently, the CSEO stock is down to around $48, which is near its 52-week low because of supply chain issues that caused a 20% reduction in orders, which in turn forced the company to reduce its revenue projections for the 2024 fiscal year by around 6.6%. However, the declining price possibly doesn't reflect the company's planned 2024 $28 billion acquisition of the software company Splunk. This company specializes in analyzing data via AI in order to identify major issues in a business and prevent them. According to Cisco, combining these two established leaders with complementary AI, security, and observability capabilities will unlock the true value of data for clients. It will help make organizations of all sizes more secure and digitally resilient. So this acquisition is expected to make Cisco a significant player in the cybersecurity space, especially since Cisco followed it by announcing its new AI assistant for security, which is trained on one of the largest security-focused datasets in the world, one that analyzes more than 550 billion security events each day. Cisco also supplies critical products to the AI infrastructure, such as its machine learning platform. The company also recently revealed forecasts that AI-related orders from its major cloud provider clients would increase its earnings by over $1 billion in the fiscal year 2025, nothing that Cisco is now in its 2024 fiscal year. This move into the AI sector is strategic as the global AI market is expected to hit around $2.5 trillion by 2032, after reaching $454.12 billion in 2022. The company's dividends are stable, with a yield of 3.22%, and they have increased for 16 consecutive years, which is especially attractive for a tech stock. Its entrance into the expanding AI race could offer it an opportunity for growth. In addition to the AI catalyst, Cisco is a trusted brand that makes essential products such as routers, phones, and servers, which could make the stock more safe to own. Investors who are interested in CSEO stock may find it a good opportunity to allocate a small portion of their portfolios to it and take on the stable, increasing dividends. At the same time, enjoy possible future growth fueled by AI. There are many great options for dividend stocks, and many might think one is better than the other, but what is agreed upon is that you need to diversify your portfolio in order to make profits. While some dividend stocks market themselves as passive investments, you still need to do your homework and research the stock extensively or even seek professional help in order to be aware of the potential risks. It's important to know that general market risks affect nearly every stock, so diversification should go beyond industries, asset classes, companies, and geographical locations. Well, that is everything for now. What do you think? Will you consider buying any of these stocks? If not, which stocks will you get before the new year? Please let us know what you think in the comments below. And if you haven't, please subscribe and leave a like for this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.